So I sent an email out last session. Okay, great. All right, so just housekeeping rules we're going to talk about, or an update. I sent a couple emails out last couple weeks ago, including a link to the Zoom meeting. Did anybody get a chance to look at it, see if it worked? Anybody test it out? Anybody? Well, take a look at it when you can. Again, it's there. I'm going to do the same thing for this one. My understanding is you could download it from your end. Matthew, I believe you're still providing your recorded updates, so continue doing that. All right, so that's it. But again, should be there. Again, I don't know if it has a time period in terms of it, if it's removed from the from the cloud. I'm not sure. All right, so today we're gonna do a quick review of stuff that we covered previously. Actually, with the chapter, um, stop, open. So we talked about tax deductions. Last session, we went over the vacation home problem. There's a couple problems from the book that we're going to go over today in chapter 6. We are going to get started with chapter 7 today and Wednesday. So the midterm will be tested on chapter 7 to some extent. I'm not going to include net operating loss problem until the final. Uh, Unless I change my mind, but I don't see that happening. So I'm not going to include that net operating loss problem until the final. So on the final is going to be more comprehensive. So first things first, let's take a look at the. All right, so this is the one we're going to do a quick review today. Talk a little bit about, then this is more on chapter 7. Again, we are going to get started with chapter 7. The only thing that I won't test you on yet, at least, actually, this pertains to more than just chapter 7 stuff. This is not the one I wanted you to see. Um, we'll get to that. Hold on. Six. That's 6, right? Okay, so you take a look at those articles. There's more articles that's been released. So again, quick overview in terms of business deduction. What's not a business deduction? Remember, charity is not considered a business deductions. You can't make illegal bribes, political contributions, fines if you get hit with a fine or a penalty. And that includes late filing penalties. Any penalties that we talked about, or any penalties that are imposed by another jurisdiction, those are not deductible. Political contributions not deductible. We talked about meals. Meals, you can only deduct 50%. In some cases, you can deduct 80%. We'll get into more detail on that a little bit later. Entertainment is no longer deductible. 100% of it is no longer deductible. Actually, I don't think we went over this one yet. Um, no, we didn't, right? No, we didn't go over this one yet. So this is should be new. So remember the that BHIP mnemonic, the business deductions. Remember, business deduction has entrepreneurial effort and profit motive, meaning you get business deductions, and that's subject to Section 162 of the Internal Revenue Code. Hobby deductions, on the other hand, there's no profit motive, but there's entrepreneurial effort. Those deductions are limited to gross income. But considering right now that it's been temporarily suspended, the 2% AGI deductions until 2025, so there's no deduction for hobby expenses. Same thing for production of income deductions. Those been temporarily suspended. Again, as far as Section 262, that's the governing, a section of the code that tells you that you cannot deduct a personal expense. But we all know that, we could deduct personal expenses. There are itemized deductions that are allowed in credits. But that's, it works this way. Again, it's not deductible unless there's a credit or a section of the code that tells you. Who is that? Please put your microphone on mute, please. Unless you want to say something. All right, so bad debt expense. We haven't talked about bad debt expense. We sort of touched on it briefly. In terms of bad debt expense, what is deductible and what's not deductible? The bad debt expense that's allowed only for accrual-based taxpayers, which kind of makes sense. On the accrual-based income statement, you recognize income when you earn it, not necessarily when you receive it. So you're accounting for some uncollectible receivables in there. As you know, for you're accounting for bad debt, that's the whole purpose of that is to write off uncollectible accounts or expense uncollectible accounts. But remember, in accounting, generally accepted accounting principles, there's a couple steps to get into what you actually have to expense. Short and sweet, it's called the allowance method for accounting purposes. Remember, the journal entry is something like debit, bad debt expense, credit, allowance for doubtful accounts, or allowance for uncollectible accounts. That's the allowance method. Again, that allowance method is based on an estimate. Either you're doing it based on your income statement, you're doing a percentage of sales or credit sales, or you're doing a percentage of receivables. Regardless of what method you're using, you're basing it based on an estimate. That's GAAP. Again, that's GAAP. That's when you do the GAAP journal, that expense credit allowance for doubtful account. So maybe I should write these journal entries down so you can visualize these. So let's do a little GAAP accounting. So GAAP accounting. So we got journal entry number 1, journal entry to record estimated bad debt. Again, without getting into specific, let's just do, again, what's the journal entry? Bad debt expense and some number, right? And then allowance. Now, again, I'm going to just say allowance for DA doubtful accounts. That's your journal entry, right? Now, the other journal entry you may see in GAAP accounting is once you write it off. So journal entry to record. Well, so once you determine once a receivable is already uncollectible, the journal entry to record specific receivable. I can't even spell today. Receivable deemed uncollectible. So let's say you did a search of which receivables are uncollectible. There's some insolvent customers, or maybe some customers filed bankruptcy. You know those customers are not going to pay you. You have an idea that they're not going to pay you. So that journal entry goes something like, oh, it's not letting me. It's acting up again. Well, anyways, the journal entry is debit allowance. I don't know why it's doing this, and then credit. This is so weird. What do you credit? Let me see if I can do it in Excel. Anybody know that journal entry to credit? Come on, you guys took accounting class.
A specific receivable account?
Yes, but what's that journal entry? It's a basic journal.
It's a credit to that person's account.
Would be what we would expense, like.
No, I think you guys are missing the. Think about it. Basic journal entry. When you book a sale on account, what's that journal entry?
Sales or accounts receivable. Debit accounts receivable.
You debit accounts receivable, you credit sales, right? So once you determine a specific customer is not going to pay you, what do you do then? Somebody sort of hinted on this, but it's you credit. I don't know. You credit allowance for doubtful accounts. I mean, you debit allowance for doubtful accounts. So I guess maybe let me ask you a different question. When a customer pays you and that account that's due, what's that journal entry? Everybody should know this one. A customer already paid you on something on credit. What's that journal entry? I'll give you part of the journal entry. Debit cash. What's the credit to?
AR.
Accounts receivable. So why are we crediting accounts receivable? Because we have to take, and somebody hinted on this. We got to write off that specific customer off, or not actually write off. We got to bring that specific customer to zero, right? Same principle here, but you're going to credit allowance for doubtful accounts. I mean, you're going to debit allowance for doubtful accounts, and then you're going to credit accounts receivable. So it has the same purpose as when you were debit accounts receivable, and when you're collecting an account, you're bringing that customer's account back to zero. So the journal entry that I'm referring to is this one. It's going to be debit allowance for doubtful accounts, credit accounts receivable. Remember, that's when they already determined that specific account is uncollectible. That's when you write off for tax purposes. That's the only time you write it off. Here, not why is it giving me trouble? Give me a second. Let me stop sharing and start sharing again. Anyway, again, this is where you would do the second journal entry. That's when you actually write it off. Once you determine which which specific account is written off, and that credit goes to accounts receivable, not the allowance method. So you don't write it off here when you estimate it like you do in accounting purposes. You would write it off once you determine what specific accounts receivable is written off. That's when you write it off. Again, you cannot use it for cash method of accounting. Why not? Because you're only counting what you receive in cash. A receivable is something you haven't received yet. Bad debt by expense has to do with uncollectible receivables, as you all know. So an uncollectible, cash receivable doesn't necessarily make sense. Again, it has to be on accrual-based taxpayers. Cash-based taxpayers do not get this benefit. I guess the only rare example would be something like that dealt with the timing of a check and the check bounced, and that customer never paid you back. So going back to my example that we went over like a couple sessions ago, where a customer gives you a check and it's assuming that you have knowledge that the funds are available at December 31st, and you made the deposit December 31st. So it's income to you in that period. You recognize it income in that period. So let's say next month, it's going to be an in-transit item because it's December 31st. So it's not going to appear on December's bank statement. It's going to appear in January's bank statement. But I'm sure some of you may be familiar with this. When somebody gives you a check that a rubber check, as they call it, an insufficient funds check, that check doesn't get cleared right away. Some banks actually present it more than once to be deposited. Sometimes some banks just try to deposit it once. Whatever their procedure is, it may take a week or two for you to actually know that actually is income to you. But you filed your taxes early, you already recognize it as income, and now you got a rubber check. Then in that rare situation, you'll have a uncollectible account. But again, it's very, very rare. I know I gave you a convoluted, situation, and it's there for a purpose. Again, cash basis taxpayers cannot use bad debt expense as a business expense. Again, only accrual-based taxpayers. Again, that's the whole purpose of bad debt expense. Now, I hinted about this before, the non-business bad debt expense for, can somebody write off uncollectible receivable that they haven't, personal receivable? So what do you guys think of that? In that case, can they write it off? Well, yes, it has to be a bona fide loan. meaning there usually an existence of a promissory note would substantiate that you do have an actual loan. Absence of that, you will get audited, and chances are they would reverse that. It's treated as a short-term capital loss. Again, remember, regarding any types of capital losses, they're limited to $3,000 or $1,500 separate. But again, that's the limit, $3,000, and the excess carries over. I don't know if I gave you an example. This is somewhat a true story. So let's say I gave a loan to an ex-girlfriend. She signed a promissory note. Let's say it's $10,000. So she signed, it wasn't $10,000, but let's just say it was $10,000. I would not lend somebody that much money, but let's say it was $10,000, and she signed a promissory note. And then, as things happen, it didn't work out, so we stopped talking. But by the way, she still owed me money. She signed the promissory note. She kept telling me, "I'll pay you back. I'll pay you back." And guess what happened? She never paid me back. I don't remember the additional facts, but I do remember contacting her, and that I was unsuccessful with that. I'm gonna say she eventually changed her number. I don't know if it was because of me or she changed her number. So I hired an attorney, and the attorney attempted to collect the receivable. She was nowhere to be found. Can I write off that receivable? Do I have a promissory note? Can I justify that it's considered a loan? Yes. How would that loss be treated? It's a short-term capital loss. Well, let's go over the capital loss rules again. Assuming I don't have any capital gains in any of those years. So let's say this happened once I determined, once my attorney and I determined the note to be uncollectible. Let's say that was 2019. Again, I haven't sold any stocks in any of the years. Let's just say, how much can I write off in 2019? $3,000, right? How much can I write in 2020? $3,000. 2021, $3,000. What's left over in 2022? Come on, you guys can do the math. Should be $1,000, right? You guys see how that works. That the basic property transaction rules, I could only deduct, in terms of capital losses, that is, I could only deduct $3,000 of capital losses in each year, unless I have capital gains to offset it against. But I had no capital gains, so that's why I gave you that $10,000 for a reason. I can deduct $3,000 per year, so $3,000 year one, year two, year three, year four. I could only use $1,000 because that's what's left over. Again, basic rules as it relates to capital losses. We'll go over that in more detail. But as it relates here, this is treated as a short-term capital loss. Again, non-business bad debt. I guess that would be like the only time a cash-based taxpayer can write off bad debt expense, but it's not because of the nature of the business, because it's a non-business bad debt. Now let's talk a little bit about a couple different losses in terms of investments. So I remember I told you that if you start a business, the business has to, in order for startup expenses, you actually have to start the business in order for you to write off the actual business expense. So that is true. But what about an actual investment? If you invest money into a business entity and that business entity is no longer successful, can you write off losses in that case? Well, it's facts and circumstances. Let's go over the first rule. The first rule actually relates to, it does relate to some worthless securities, but it actually relates more to when you sell a stock that is actually worth less than what you put in. And this is how it works, the Section 1244 stock. And this is pretty much for small businesses, it usually works. So taxpayers may deduct an ordinary loss on the sale of qualifying small business stock. Again, either the sale or once it's determined to be worthless. So the small business stock is defined as paid in capital at inception. So the original paid in capital when the corporation was formed cannot exceed $1,000. And only those taxpayers, only those shareholders that form the corporation at inception, only they can benefit from 1244. Additional shareholders after they come in, they cannot benefit from Section 1244. It's only the original shareholders. As long as they put in no more than $1,000, then they'll be able to write it off. Again, in terms of the maximum amount that can be written off, it depends on your filing status. So it's $50,000 for single unmarried taxpayers, $1,000, $100,000 for married taxpayers. But that assumes that's how much you put in. Keep that in mind. It's basic principle: selling price minus your cost. Again, let's say the selling price is $1, then your cost would have had to been at least $50,000 in order for you to absorb that loss, or $100,000. Again, that's your actual cost. Remember, you get to recover that, you know, and determine that when you figure out the gain or loss. The excess is treated as a capital loss. So let's I sort of wanted to walk you through an example, but I think my printers are my keys are acting up right now. Will be a good. Okay, so let's say hold on one second. Let me. I don't know what I can do. Hold on, I'm gonna pause the recording. I don't know why it's doing this. So this is what I'm gonna do for a few seconds. I'm signed off. I'm gonna sign off with this laptop, but and I'm gonna use the. You're not gonna be able to see me, so I'm gonna use another computer. I'm logged in. But I gotta switch everything over. So just bear with me. I don't know what happened here. My keys are acting up, so just bear with me. I'm not gonna end the meeting. The meeting is still going on. I just paused the meeting. I'm just gonna sign out. How do I sign out without ending the meeting? Let me see. Hold on. So hold on. I already. Can you guys hear me? Are you guys can hear? All right. So just bear with me for a second. The other computer is booting up. Maybe I'll just do it this way, because I don't know what's going on with the other computer. Come on. All right, so we're back where we left off, I think. Come on. All right, so here's my example real quick. Back to where we are. All right, here. So let's say I'm a sold small business for $10,000. Her basis was, again, this is how much you put in, $80,000. What is her gain? Just based on these, or her loss? Based on these facts, what's her loss? Anybody? You guys hear me? Wait, let me record it. Sorry, gotta record it again. How do? I don't think I can record from this computer. Oh no, I'll resume recording. Never mind. All right. So here are the facts. Resuming back on this one. Is it recording?
Yeah, it's recording.
It says it's recording. Yeah.
Good. Yeah, I'm having technical difficulties, so I apologize for this. I don't know what's going on today. All right, so here are the facts. So Ima sold small business stock for $10,000. What she paid for the stock was $80,000. What is her loss?
70,000, right?
Everybody okay with that, right? So
Yeah.
so selling price. So I'll do real quick. 10K minus 80K equals 70K. So this is how it works. Again, assume I'm a single. Ima may, now this one's acting up. May deduct. So how much can she deduct? She's single. $50,000, right?
Yes, as an ordinary loss, and then she can take another 3,000 in capital losses, right?
Yes, and exactly. So 3,000, very good, in capital loss. The excess, how much is left over? So 70 minus, so we took 53. So what's left over? 23, is that right? No, wait, math is off. Wait, 27, yeah. So the excess of, yeah, my math is off today. So what is it? How much is over? 17, you said?
17.
Yeah, 17 is carried over as a capital loss. So that's how that works. So the first $50,000, because she's single, the first $50,000, you're correct, Matthew. The first $50,000, you'll be able to write that off as an ordinary loss, and then $3,000 is a capital loss because the excess is treated as a capital loss. So first of the $70,000, $50,000 is ordinary, right? Everybody okay with that, right? So what's left over? $20,000, which is left over, is capital, right? What are the rules for capital losses? Then you go back to the capital loss rules. You can only deduct $3,000. So what Matthew and I did, we actually sort of just walked through it very quickly. But I want you to think of it in steps. Deduct first $50,000, and then the rest is capital. So $20,000 is capital, right? $50,000 is ordinary. So how do we treat capital losses? Again, assuming that this is it, you can offset capital losses with capital gains. But assuming they had no capital gains, then in that case, it's $3,000 in year one, and then the excess $17,000 is carried forward until the new year, or the next year until it's exhausted. Okay. All right. So that's for that one.
And that's 10,000 minus 80,000, right? For the 70.
Correct. Yes. I hear an echo. Hold on. Is that better? Can you guys hear me? Okay.
Yes.
All right, so I'm sort of working from two different computers. The microphone is on the laptop. I'll switch over in a bit, but since I'm already here, so everybody okay with this discussion in terms of small business losses? Yeah, again, it only works at exception. It's only the original shareholders. But let's say Ima let's say she was married, then it'll be up to $100,000. So in this case, it'll be the full amount, $70,000 as an ordinary loss. So again, there's always more benefit if you're married filing jointly, as we talked about several times. Worthless securities, you can actually use these two code sections, together, but they can work independently as well. Worthless securities, that's when, and that's just not limited to the original shareholders. That's pretty much when any type of security either a debt instrument or an equity instrument becomes worthless, meaning the company is no longer in existence or they're insolvent, they're winding down financial affairs. You can't really sell anything. It's considered worthless. But again, I mentioned here, if worthless securities consider small business stock, up to $50,000 is, or $100,000 is considered an actual loss. If it's a capital loss, which is most of the cases, then it's $3,000. So you'll go over the same rule, except with this particular example, the selling price is considered zero because you can't sell it anymore. So keep that in mind. When it comes to worthless securities, that's when a security is determined that it's no longer worth anything. You can't actually, make any money from the sale. Doesn't necessarily mean because a company filed bankruptcy, but that can be an indicator if they're insolvent. If a company closed operations, of course, then you can't sell the security at all. So cease operation is, a no-brainer. But if they file for bankruptcy, that all depends. As you know, when a company files for bankruptcy, that's not necessarily the end of the company. That's just a restructuring. It's a legal way to restructure your financial affairs, and you can even do that on the personal side. So you can still exist even if you file bankruptcy. So for worthless security, that's usually when the it can even be a new venture. You put in money into a new venture, and they did start the new venture. Then they didn't have enough customers, and they didn't last 2 years or whatever the case may be. But again, you could use worthless securities and also Section 1244. I want to talk a little bit about casualty theft losses, just briefly, because these don't really apply that much anymore. Well, for businesses they do, but not on the personal side. But when it comes to business losses, if it's a casualty loss, it's a deduction for AGI. If it's a business property, so if it's a fixed asset, then it's a deduction for AGI. But if it's a non-business asset, it's a deduction from AGI. It's considered an itemized deduction. But as I mentioned before, under the Tax Cuts and Jobs Act, only casualty and theft losses that occurred in the federal disaster declared area are allowed as a deduction from AGI as an itemized deduction. So that's only for federal disaster declared areas, and that's only 2018 to 2025. For prior years, prior to 2018 to 2017, prior years, all personal casualty theft losses were allowed, assuming they meet the criteria. But right now, it's limited to a federal disaster area. So think of the hurricanes, any earthquakes. Again, it has to be declared by Congress that it is a disaster area. There's a couple of floors in terms of applying it. It's $100. Oh, and this is just for personal losses. For business losses, there's no floors. For non-personal losses or non-business losses, personal losses, there's two floors. The first floor that you have to apply is the $100 per occurrence floor. So each loss that occurs in that particular year, you subtract $100, or in essence, it's whatever is in excess of $100 is the allowable loss, and then you add up all the losses, and then the next floor the next hurdle that you have to get over is the 10% AGI floor. So again, $100 per each occurrence, and then 10% overall floor. Again, that's for personal casualty theft losses. Now, in terms of measuring the loss, it's the same for business as it is for non-business personal losses. If it's partially destroyed, it is the lesser of decline in fair market value or adjusted basis. That's for partially destroyed. If it's totally destroyed, then the amount of loss is your actual basis, your cost basis. That's the amount that you'll be able to deduct. But you also have to take into account, if you're getting reimbursed by your insurance, you have to take that amount off of your loss. If your insurance covers your loss, then you don't have a loss. That makes sense, right? If your insurance covers your loss, you don't have a loss. But what if your insurance exceeds the actual basis? Can you have a gain? Perhaps. So it can also trigger capital gains or other types of gains if your insurance company reimburses you more than your actual cost basis. So again, let's say you bought jewelry, and assuming that it falls within the federal disaster declared area, and the jeweler you bought it was actually, you bought it for less than what it's actually worth. Your insurance may actually cover you more, and you may actually have an actual gain. That gain has to be recognized. So you also have to keep in mind, again, the insurance reimbursements. Now, in terms of the criteria, it's pretty straightforward. The criteria, it has to be a sudden, unexpected, and unusual in nature. It's I guess the good way of putting it, an act of God, an unusual event, infrequent event. It has to be identifiable, and of course, it has to be damaging to property. Again, not so much I want to cover on this. I do want you to know it's there because the losses are there for selected amount of taxpayers and business losses. But the business losses are pretty straightforward. It's a deduction for AGI. Net operating losses. Yeah, let me talk about this, and then there's a problem that I want to do, because this is actually pretty. Again, I do want to get into net operating losses. I'm not going to test you on this on the midterm, but this will be tested on the final. So net operating loss, it's when a taxpayers are allowed a loss when the business and there's a loss. Now it all depends, and it may be confusing the way I set it up, and it may not be consistent with your textbook. A textbook has slightly different rules, and the reason for that is because tax laws change. But I'm going to tell you what the book has first. For tax years 2017 and before, the carry back, meaning they can carry back the loss 2 years, carry forward up to 20 years. So you carry back 2 years to the earliest year first, and then if you have anything left over, you carry it forward for up to 20 years. So again, let's say I have a net loss in 2017, then I would have to carry it back to 2015 first, then 2016. If I have anything left over, I can carry it back to 2018, 2019, and so forth. So that's how it works. I have to carry it back to the earliest year first, and then carry it forward. Again, NOLs can be carried forward for up to 20 years. Now, how much can I use? Well, whatever my taxable income is, whatever year I'm carrying it forward or carrying it back to. So in my example, let's say I had a loss of $50,000 in 2017. So actually, let's sort of do it over here. So here's an example. I'm just basic example. Net NOL, well, in 2017 was, let's say 80,000. 80,000. Or taxable income for 2015 was, it gets more complicated than this, but just going over the basics. So let's say taxable income for 2015 was 10,000 or 15,000. And 2016 was, let's say 5,000. So how much can she use for those years? So in this example, she can carry back, so 20, right? 15 in 2016, or I mean 15 in 2015 and 5,000 in 2016. So she carries back 20,000. So again, in 2015 and 2016. The excess, what's left over? If I'm using 20 of the $80,000, what's left over? 60, right? 60 is carried forward for 2018, and future years. You see how it works? I can use it up to my taxable income. That was the old tax law. And under the old tax law, I can, whatever my taxable income is, that's the amount that I'll be able to use and get a refund for it. So it's generating cash flow for the businesses. And then I can still use that loss in the future years, which is actually very great. So it's allowing me to get back on my feet. I like the old rule a lot, but the new rule has changed. So and this is part of Tax Cuts and Jobs Act. So for 2018 to 2025, NOLs are carried forward indefinitely, no carryback, so only carry forward. And then no NOLs are limited to 80% of a future taxable income. and that's pretty much it. But as you know, this is going to be a bit tricky because I'm going to tell you right now that forget everything I just told you. So let's use this set of facts. Yeah. Again, this example, Ima had a taxable income NOL in 2018 of $80,000. Then in this case, it doesn't matter what it is in the previous years, right? So, but let's just say we're projecting what her taxable income is next year. So let's say her taxable income for 2019 is projected to be, let's say, 20,000, and in 2020 it is 30,000. So based on these facts, remember she cannot carry it back. Ima can use, so what's 80% of 20,000? 16,000, right? 16,000 of her NOL to offset 2019. And so what's 80% of 30,000? 24,000, right? 24,000 to offset 2020, right? The excess of, so in this case, we only use, so 16, we only use 40,000. So the excess, what's left over, 40,000 is carried forward. Now, do you guys see something, different between here and the first set of facts in terms of which one would generate more revenue for the government? Second one, right? So remember the Tax Cuts and Jobs Act, they had to find ways to fill in the gaps. Again, it was a revenue bill, so they had to find ways to generate revenue. So in this case, think about it. They're not carrying it back, so they're not allowing taxpayers to actually generate refunds from back taxes. So they're not allowing them to do that. So the carryback is gone. But in terms of carry forward, it's limited to 80%. So let's go over these facts again. So for her 2019, she's offsetting only $16,000. So she's paying taxes on $4,000, right? That's bringing money to the government. So $4,000 is still taxable income to the taxpayer. And then in 2020, they're using $24,000. So she's paying taxes on $6,000. Again, generating revenue for the government. So that's how it was designed to create. They're still allowing taxpayers to use the losses, but it's still generating some type of tax revenue for the government. Now, forget everything I just told you, because this is the CARES Act. Under the CARES Act, oh, by the way, what I'm going to test you on is this, whatever I just covered right now. I do want you to be aware of the CARES Act, because that's just passed March. It just passed in March. I do want you to be aware of that. I won't specifically test you on this, but this is all that CARES Act really does. NOLs for 2018, 2019, and 2020, it pretty much goes back to the old rules, sort of, with some twist. But instead of carrying back, 2 years, they carry it back 5 years. But it's not limited to 80% of taxable income. NOLs can offset 100% of taxable income. Carry back or carry forward, it can offset 100% of taxable income. So it actually made this NOL rule a little bit better for now. Again, for losses for 2018, 2019, and 2020, it's sort of like a hybrid in a way, a combination of both rules. Some of the old rules where you're using 100% of the NOLs, and then also the ability to use carry it back, that's still there, except it's 5 years. It's a good thing. Now, in terms of if you're carrying it back, how should you do it? Well, I got the forms there, but some of you are probably thinking, so how will we address this when we make a change to a tax return? Those of you who are familiar with doing tax returns, you may remember that it's you amend a tax return. You got up to 3 years to amend your tax return. There's a much quicker way to do this. If it's related to a net operating loss, for individuals, it's Form 1045. it's pretty much the same process as doing an amended return, except it's just one form. For corporations, it's 1139. Again, the 1045 is a lot better. So think of it this way. I mean, 1045 is a lot better than doing the amended return. Because think of it this way. If you were amending the return for this taxpayer in a beginning set of facts, you would have to amend 2015 tax return, right? And then 2016 tax return, separate tax return. But how about you just do Form 1045 and just do them both as one tax return? It's an application for a quick refund, and that's the name of the form. It's for a purpose. Again, if you're familiar with doing amended returns, that can take months to do an amended return. An application for a quick refund, it's the period is shorter. Again, let's say an amended return takes about 4 months to process your return, 3 to 4 months to process your returns. The application for quick refund would take about a couple months, 2 months to process your application. So much quicker in time, and even in some cases, 1 to 2 months, depending on the circumstances. Again, taxpayers can amend the return, but an application for a quick refund is quicker. Now, in terms of doing the NOL computation, I will get into this in detail. I'll start with the computation today. I'm not going to test you on the midterm, but I do want you to know what it is. These are the steps that I want you to memorize, or at least have an idea what they are for right now. For the final, you will have to memorize these. So step number 1, we compute the net loss from the business. So that's figuring out the net loss from the business, Schedule C. So you're doing business income minus business expenses. That is not your net operating loss yet. That's just a starting point. Then we have to pretty much do the whole tax return. So net loss, then you add gross income, then you subtract deductions for AGI if there are any, and then you would also subtract your deductions from AGI. So these are the next steps. Again, you have to figure out adjusted gross income and then taxable income. So you're doing the tax return up to taxable income. If taxable income is still negative, then you can continue working on it to see if you have a net operating loss. If taxable income is positive, you can still go through the math, but you're not going to have a net operating loss. Again, taxable income has to be negative. I know some of you are probably thinking, well, that's not what the forms say. The forms say, the instructions of 1040 say never use a negative number on 1040. Well, that's the instructions. When you're actually doing a computation, taxable income, in order for it to work, should be a negative number. It should be a negative number. Remember, the instructions to the forms and the form itself, that's not primary source of tax law. The code itself is primary source of tax law. Now, once you figure out what the net operating loss is, once you go through the steps, which is step number 4, this is the actual loss. And it does take some, work or practice to get used to it. But you start out with the taxable income, and then you add back your non-business deductions in excess of non-business income. Again, non-business deductions, those are deductions that are non-business. Non-business income, those are your income that's non-business. So it kind of sounds a little bit funny. Sort of think of it this way. We talked about active income, which is your material participation, your earned income, right? Then we talked about portfolio income, which is your interest, dividends, capital gains. That's unearned income. Portfolio income is considered non-business income. Active income, that's business income. So when we're making this computation, if we have something that has salary is considered business income because that's active income. If we have interest, that's non-business income. So keep that in mind. We'll go through an example in a little bit, so you can, so we can walk through it. And then as far as 2018, the NOL computation is a bit different. The only other step is we're adding back personal exemptions, because that's a non-business deduction. That's what we're adding back. Now, the excess business losses, again, this is in your book, so I'm going to cover it, but I'm also going to tell you that it's no longer exists. I don't know if I hinted about this before, but this is something to think about, considering what's been happening with the CARES Act. It is there to help out businesses. But the excess business losses rule, that was used as sort of another way to curb tax shelters. So individuals, mostly the wealthy individuals, middle income to upper income individuals do not benefit from claiming a significant amount of losses. So they put a cap on the losses, again, business losses. Now this one, it again limits the amount deductible losses for non-corporate taxpayers, which I always found it funny. Corporate taxpayers, corporations, C corporations are, different. This doesn't apply to C corporations. Excess business losses are disallowed and carried forward as part of NOL. So whatever is considered an excess business loss, that would just be added back to the NOL carryover here. So here's what an excess business loss was defined. It used to be defined as any, again, aggregate business deductions attributed to business. Again, that's for the step one, as I did before. And then, again, this is your step one, your step two. So that's what we're doing there. And then we have any losses. And you're combining different entities as well, different activities. So that's why we're adding them in 3 different levels. Then if you still have a loss, let's say they still have an NOL of, it used to be 250,500 for married. Then that gets capped off. That's the maximum amount that you'll be able to deduct. Anything over that amount is an NOL. Again, it used to be 250 and 500,000. For 2020, it's supposed to be 259,000 and 518,000. But here's an update. Forget everything I just said. CARES Act repealed this whole section. Period. So I know your book gives you this. It has good intention. I like this code section because in theory I agree with it. But now it's gone. It's gone. So it's going back to the old loss rules. So let me this is over. While I go back to my regular.
Quick question: when you says it repealed it, is it for a set period of time, or is it just a complete amendment to the tax code going forward?
It's been repealed. Completely repealed. Yeah, my thoughts exactly. Why would they repeal that? Is that what you're thinking? Well, I guess my explanations to that is, now, do you understand why they made changes to the NOLs on a temporary basis for 2018, 2019? Everybody understands that because that's mostly for 2020. A lot of people are they're gonna suffer losses this year. So I get that. Everybody understands that. There should be some type of temporary relief. And keep in mind that was only for 2018, 2019, and 2020 for that. But why is it that the one that actually pertains to that's going to help out only a selected amount of taxpayers is been repealed, completely? Because think about it, not everybody is going to reach that cap, $250,000, $500,000. You would have to have a large number of laws to actually reach that cap. And only people that have all these business activities, again, usually people that have the wherewithal, the resources to have these, invest in these activities, they'll reach levels of $250,000, $500,000. Again, that's not going to happen to every small business mom and pop shop. And I think what would have, in my opinion, that this is I think that it would have been better the other way. The NOL should have been extended further than instead of repealing the excess business losses. But yeah, that's the way Congress works for you. Just so you know. Again, it's not all bad. It's it does have like some benefits, I guess. So it's not all bad. But just as as a side note, I guess let me get back on video. Am I back on video? Can you guys see me? Oh, there you go. Hi guys. All right. So think about this for a second. Again, I'm trying not to be political, but taxes are political by nature. If you think about it, it's hard not to be political. But just something to think about. I'm sure many of you heard about a certain president that has not revealed his income tax returns. You know who I'm talking about? Well, let's say, and let's say, I'm pretty sure you probably heard about this certain individual did not pay taxes for up to 20 years. I don't know if that's true or not. To be honest with you, I don't know if that's true or not. If it is true, that's I could see it being possible. But think about this for a second. Is it possible for anybody, not picking on any politician in particular, but is it possible for anybody under old tax law to not pay taxes? Well, we just went over the net operating loss rules. Yes, that's very, very possible. And they have made it, a bit more stricter, even in the 90s and even going forward. But even I still think it's a good benefit for businesses to get back on their feet. I still think like that side of it. But is it possible for somebody not to pay taxes for up to 20 years? Again, look at the old law. The old law was you can carry your losses for up to 20 years and you can offset it up to 100% of your taxable income. So again, I don't know if that's the case with this the President Trump. I don't know if that's the case with him. I'm gonna guess that that's probably the case, that he invested in a business that had nothing but losses every single year, or the losses were so significant that he had to carry the losses up to 20 years. So that's very, very possible. And I'm also thinking that that's probably the case because he did also mention that he did get audited, or I don't know if that's true, but his return is under examination. That's why he couldn't release the tax return. People that have net operating losses, especially excess business losses, and this is before the excess business losses were even passed. We talk about the hobby loss rules. If you have 3 losses out of the last 5 years, they're going to challenge that. And then they can even challenge this particular law. So there was all kinds of reasons why it's possible that he got audited. And it's also possible that he didn't pay taxes for up to 20 years because he invested in businesses that were generating losses for up to 20 years. So that's very possible. Now, I guess the other side of it is, the other, people, some, people that support him, give him credit for being a good business person. Just random thought, if you have a client that has net losses every single year, as an accountant, do you think your client is doing something good for business purposes? Never mind that they can write off the loss. Of course, you're always going to say, well, yeah, you can write off the loss, but this is not a good business. If you're losing money every single year, it's not a good business. Any person with sound business sense would make that, be able to ascertain that what a good business is or not. Of course, it takes years for a business to actually start generating profits. I get that. But if it takes several years and you're still in the red, you may want to advise your client to get out of that investment. That would be, my thoughts on that particular, topic. But just something to think about. Look at the losses. It is, and not just that. And in that case, I would also advise that client that, well, you're in the red, and chances are you're going to get audited because you're claiming losses every year. So it can be bad. Okay, any other questions on chapter 7? No questions? Actually, before we get into chapter 7, because I want to see if my computer's working. Hold on. I want to go to IRS.web. Have we gone over the forms yet? Have we gone over the forms? Let's do a dive down to the IRS forms. So this is what you're going to do when you're doing the tax prep project, or even if you're just looking for forms. Excuse me. So you're going to look at the IRS website, irs.gov. They changed. It's pretty user friendly. Some of you may already be familiar with this. You can make a payment here. You can get information on tax relief and so forth. But I think it's better for and as it relates to forms, just use a search function. So we did go over some of the forms before. So 1040. Now the tax preparation project I'm asking you to do 2018. Do not use 2018. Use 2019. I forgot to update. So use 2019 forms. Again, click on 1040. Pretty straightforward. You download this form and you use the fill-in information. Again, it's working. So as terms of the social security number, if I didn't give you one, just use 1, 2, 3, 4, 5, 6, 7, 8, 9, right? That works, right? The address, I think, is 30 East Lake Street, right? Chicago, Illinois. Is it 60601? Anybody know? Is it six? Yeah, does that address sound familiar? Anybody? That's the address of the school. You guys all fail. You guys should know the address of the school. That's gonna be on the midterm. What is the address? So make sure you write. Really? Never? Uh, well, that's the address of the school. So, all right. Again, and if you're gonna be claimed as a dependent, this information is filled out. Again, remember I told you about the itemized deduction. If your spouse itemized, they have to check this. Even if you don't identify it here, you'll get audited. Dependent information would be here. Again, basic, 1040. Again, a lot of information's here. Now, they did change the form a bit from the 2018. I want you to use this form instead. The 2018, it's I don't know. The 2019 form, they were trying to mirror the 2017 tax forms prior to the Tax Cuts and Jobs Act. They did an okay job on it. So pretty straightforward. Make sure you fill this out, standard deduction or itemized deduction. If there's an itemized deduction, use Schedule A. Again, make sure all this is filled out. Pay preparer information, that's your information. It should not be self-prepared. That information is yours. Your designee information should be here. Again, if it's what I usually do in this particular case, yes, I'm the designee. In case the IRS has any specific questions on the tax return, I can answer them. The tax, we already showed you how to do the tax, use the tax rate schedules. Now, in terms of the child, no, there is no dependent, so there's no child tax, any credits in this case. So the only credits that relate in this case, which is what? The federal withholding, that's it. So the federal withholding minus whatever their tax liability is, it's going to be tax due or a refund. So that's your 1040. Now we also have several Schedule 1. You probably need a Schedule 1, I think. And I'm pretty sure you need a Schedule 1, I think. I'm going to say yes because there's other income. Remember I said for other income, again, the top has to be filled out, but other income is going to be something like C statement, and then you're going to have to type up a statement, right? And then your total is going to be here. So let's say the total is whatever, $5,000. And then let's say the $5,000 consists of hobby income, gambling income, and so forth. In your statement, you're going to list each amount, and that's going to total up to $5,000. Again, the statement is going to be pretty straightforward. It's going to be the name of the taxpayer, the Social Security number, the tax form 1040, the Schedule 1, line 8, that identifies what form it's going to go to. So that's for Schedule 1. I don't know if you're going to have Schedule 2. That's a determination you have to make. Wait, what happened? Wait. All right, now it's acting up. Schedule A, itemized deductions. Schedule A is pretty straightforward, right? Schedule A, itemized deductions. So let's review itemized deductions since we're on the topic. Medical expenses in excess of 7.5% of your adjusted gross income. Again, you put your adjusted gross income here, 7.5% here. Only the amount in excess. So if one is more than 3, that's your deductible expense. If one is less than 3, you're less than the floor. You're lower than the floor. No deduction. And taxes, state income tax or sales tax. But sales tax deduction was something that was supposed to be suspended, but they extended it. Real estate taxes. Now, this whole section here, as part of the Tax Cuts and Jobs Act, state taxes, real estate taxes, that's limited to $10,000. Again, limited to $10,000. Now, let's take a little, dive into interest. Now, interest expense, and I'm just going to briefly cover the interest expense for right now. Again, when we cover itemized deductions next week, we'll get into more detail. Mortgage interest and points. Now, in terms of points, what kind of points can you deduct? That's prepaid interest. That's your loan origination fees or loan discount fees. How much of it can you deduct? Well, it all depends. If this is your first mortgage, your acquisition indebtedness, as they say, then you can deduct all of it. So you pay the points when you buy it, it's all of it is deductible. But let's say you refinance, then you pay points when you refinance. If it's a refinance, it gets amortized over the life of the loan. Again, if the points are paid at acquisition, it gets written off right away as part of the interest. If it gets paid when you actually refinance, it gets amortized over the life of the loan. Okay, that's for interest. And then even if for seller finance, I'm sure you probably heard about seller finance. There's no 1099. For that, you just put the person's name and social security number. They would have to report it as income, but this is how you would report it on the Schedule A. Mortgage and insurance premiums, that's something that was set to expire in 2017. That's one of those items that I remember I told you that this year they passed a tax bill that retroactively made some changes for 2018. This is one of them. Home insurance premiums, they extended it. This is Congress for you. Investment interest, that's it. Do you see home equity interest in here? You guys see home equity interest? I don't see it either, right? I don't see home equity interest. It's just home interest. Equity interest is no longer deductible. There's a couple exceptions to that. It has to be qualified acquisition indebtedness, meaning it's used to acquire, to construct, reconstruct your personal residence. So remodeling works. If you're doing remodeling to your home, it would work if you take a home equity loan. But if you take a home equity loan and use it to pay off your credit cards, you don't get a deduction for it anymore. Now, what about gifts to charity? What kind of gifts to charity? So that means if somebody, let's say, is off the expressway asking for money, and I give that person money, is that charity? Can I take that as a deduction? What do you guys think? Yes or no? What do you guys think? Would you take that as a deduction? Can you? You guys don't have an answer to this? How about if I give money to a church? Can I get a deduction for that?
Yes, but you will need like a letter, no, from the church.
Well, yeah, that's part of it. Well, yeah, yes and no, but that's part of it. But how come nobody said anything when I said the guy standing or a person, standing on the expressway asking for money? That's charity, isn't it? Why is that not deductible?
Don't they have to be qualified as a
A qualified what?
Yeah. Yeah.
You're absolutely right. A qualified what? Charity, right? All right, so you're absolutely right. I think now the letter is not necessarily required, but it does it depends on the amount. It does substantiate. Nowadays, you should ask for a letter, or any type of written documentation that shows that it was an actual donation. But that doesn't mean that again, if somebody it's $25 here and there, chances are that they're not going to have a letter, but it's good to have a letter. Now in terms of that, if that donations to all non-for-profits or some non-for-profits. Now, I think, was that you, Hannah, or somebody else?
Yeah, it was me.
All right, so you said qualified organization. Explain that a bit more. What do you mean by that?
I was just thinking about how certain charities always make sure that you could always kind of like whoever said that get the letter that they're qualified for tax purposes, or like churches often make sure you know that, but I don't know any more than that.
Okay, you're right. So you said something about a letter. Are you talking about a determination letter? Like a letter that the IRS would give you to make a determination on what type of 501c whatever organization?
Yeah.
So yeah, you're absolutely right. That determination letter would determine if you're a qualified organization that's allowed to accept tax deductible donations. By the way, all non-for-profits accept donations, but not all donations are tax deductible. So just because you give something to a non-for-profit does not make it tax deductible. It has to be, just to give you the 501c3 organization, it qualifies. 501c, well, it all depends. If it's a C6, probably not. C9, probably not. But 501c3, yes, that does qualify. Again, it all depends on the designation that's given in that IRS determination letter. And we'll go over to more specifics and more detail later. But yeah, that's the first rule. It has to be a qualified organization. But let me say, I'm very involved with the Illinois CPA Society. And let's say I'm going to give them a donation. I don't pay them dues anymore. But let's say I'll tell you why in a little bit. But let's say because I don't pay them dues, I want to contribute to some fund that's used for scholarships. Can that be deductible? By the way, the Illinois CPA Society is not a 501c3 organization. I think that's a 501c6, if I'm not mistaken, a professional organization. Can I make it? Can I make a donation? Yes. Is that donation tax deductible? Well, it depends on how you set it up. If I make it directly to the Illinois CPA Society, it's not deductible because I'm paying a professional organization. But that's not the way donations are set up, and you're going to see this a lot when a professional organization or any organization, they're usually going to set up a foundation or any type of entity that falls into the criteria of 501c3, and they're going to say, "We'll make the check payable foundation." The foundation is a qualified charity, and they will take a tax deduction. But if it's just made to the professional organization, then it's a non-deductible, expense. And that would also work for if you give it to, let's say, like a youth league, like a pee-wee league, pee-wee baseball league. That's not considered a 501c3 organization. It's not a qualified organization. But if it goes through some type of foundation, and then it trickles down to the chair, to the nonprofit, then it works that way. So that's how it works for charity. And also one more thing in terms of charity, if you donate your services, that's not deductible. Pro bono services, the value of your services are not deductible. We'll get into more specifics, later. Any questions on the charity side of it for now? Nothing? Okay, just pretty straightforward. It has to be a qualified organization. I guess, again, a lot of you identified the letter. So the letter itself is, again, that's proof, but always ask your client, do they have a letter? You're not auditing them, make a judgment. If it's a large amount, let's say somebody's saying, I gave $5,000 to my, religious organization. I'm going to ask for the letter. I don't know about you guys, but something that, large, I'm going to ask for the letter. I'm not going to put on the tax return. I'm going to ask for some type of substantiation for that amount. If they tell me they don't have it, then I'm going to tell them I can't put it on the tax return until you produce that letter. It's as simple as that. But as other items goes, like, if it's $20 to this charity, $20 to that charity, again, make a judgment call. You're not going to spend a lot of time asking for a letter for $25 here, $25 there, $100 here. Ask for it. If they have it, great. Definitely push it if it's a large number. Again, $1,000, $2,000. Again, make a judgment call. If it's a large number, yes. Now, when it comes to if it's a non-cash donation, if they're donating, furniture, if they're donating clothes, yes. If it's over $500, they have to have a receipt. They have to have a receipt. Again, if it's over the $500 threshold, they have to have a receipt. If it's more than $5,000, not only do they have to have a receipt, but it has to have a separate appraisal attached to it. It has to be a certified appraisal attached to it. Let's say art, and again, it's worth more than $5,000. Then they would have to attach a separate statement that appraises the value of that. Again, and that would be on Form 8283. Casualty, theft losses, again, that's limited. Over here, other itemized deduction. What's like the only thing that we can possibly put here? What do you think? Gambling losses, right? Right now, gambling losses, but it's limited to income, right? Losses limited to income. So that's your Schedule A. Now, since I do want you to be familiar with these forms, Schedule A, what's the next schedule? Wait, what's going on here? Schedule C. Schedule B is interest and dividends more than 1,500. We're not going to go over that. What's Schedule C? Anybody know what Schedule C is for? Schedule C? Anybody? Schedule C is for sole proprietors. So we are going to do that. Well, you're not going to do the actual Schedule C, but I do want you to be familiar with it. This is your profit and loss statement, Schedule C. Come on. Again, pretty straightforward. The name of the proprietor, business. Again, if it's a business, let's say for me, let me just do a sample one. Me is going to be me. Social Security number, I'm not going to tell you. Service, CPA, service. Yeah, just say CPA. I'm gonna look up the code number, and there's a business code and the instructions to the form. Because my business is different, and don't make up a name if they don't have it. If they do have a name, then you put the name as well. If they have a separate tax ID number, then the tax ID number should match, the business name. Business address if it's different. Cash method of accounting, accrual method of accounting. Now, I saw this a couple times this year. They have the cash method of accounting, accrual method of accounting. I laughed when I read this, and I read this more than once. Credit card. Anyone ever heard of the credit card method of accounting? Come on, I thought that was funny when I first read it. But yeah, people actually have put that as an actual method of accounting. What would be the correct method of accounting in that case? Instead of credit card method of accounting. What are they trying to say? That their payment that they receive is through credit cards, right? Isn't that the same as cash, right? So what they're trying to say is cash method of accounting, not the credit card method of accounting. It's cash. Again, if they're getting their payments, they're paying them through credit cards. So that's what they're trying to say. The customers are paying them through credit cards, debit cards. They're still getting cash on the other end. It's a cash method of accounting. By the way, again, I'm sure that nobody in this class will make that mistake. But I guess people take that too literal. That when they see cash, they're saying that it's actual cash. Nobody uses cash anymore, really. And not even me. I don't carry cash on me. Everybody uses debit cards, credit cards. That's or Zelle or what's the other apps? What's another app?
Venmo.
Venmo, yeah, Venmo. There's all kinds of apps that you can transact. Nonetheless, it's a cash transaction. It's still cash method of accounting. Don't take that literal, because again, some people take it literal, and then that would be funny if I see the Zelle method of accounting. That would be funny. All right, so that's people not reading the instructions. And again, material participation, we'll talk about that in more detail. For a sole proprietorship, it's yes. There's no reason why a sole proprietorship or the taxpayer would not materially participate in his own business or her own business. That doesn't make any sense. This information has to be filled out as well. As far as the 1099 information, that has to be filled out. You got to tell them the rules about 1099s. If they're in business with anybody and they're paying more than $600, they have to give them a 1099. Gross receipts, that information is there. So the income from the business goes here. Business expenses go here. Pretty straightforward, right? Home office expense, we'll get into that in more detail. It's right on the bottom. There's two ways of doing the home office expense. There's the simplified method, or you use the actual method on Form 8829, which may be a little bit better. So that's Schedule C. Excuse me, there's also page 2. This is for inventory. If you have inventory, mileage goes here as well. One more thing about mileage before we get into detail. We'll cover transportation expense in more detail later. But remember, your commuting miles are never deductible. So the distance between your house to your first job and back, that's not deductible. Again, commuting is never deductible. I guess the only exception would be is if you work at home. Now, work at home, actually, I should actually watch what I say right now. If you're meeting clients at home, your home is your regular business. You're not working from home. You're not just taking work home. You actually conduct business there. Then you can make an argument it is your business and it is your home. So that everything is considered, business. But for the most part, for most taxpayers, commuting is not deductible. Now, these questions has to be filled out. Now, especially this question right here where it says, do you have evidence to support your deduction? Yes, you should have to have evidence. They have to have a mileage log. They have to have, it doesn't have to be, a spreadsheet. It can even be like a piece of paper. I had clients that actually have a mileage log on a piece of paper, the old fashioned way. Sometimes that's all it takes. There's a lot of apps nowadays. MyIQ is a popular one that I know I've used before. A lot of my clients use it. There's other, QuickBooks has one, Everlance has one. There's a lot of them. Nonetheless, there's ways to get your substantiation. There's really no reason why people should not have a mileage log. That's for Schedule C. Now for C, another form we're going to see is Schedule SE, which is self-employment tax. So where is it? schedule. Actually, I'll go over the schedules SC next time when we start going over self-employment tax. Let's go over Schedule D and Schedule E for now. Schedule D, capital gains and losses. Now, you can also use another form, 8949, that they may need to be filled out as well. It all depends. But this is one of the forms that you're gonna, fill out. Now, it all depends if the basis is reported to the IRS, then this is all you will fill out. If the basis is not reported to the IRS, then you're gonna fill out additional forms, Form 8949, which is just more detailed information to Schedule D. Short-term capital gains, losses, you net the two, pretty straightforward. Now, this particular section, page 2, I want you to think about what's happening here. We're not covering this yet, but I want you to think about what's happening here, especially this particular section. 1250, that's your depreciation recapture. What's taxed at up to 25%. This is what we're going to go over, when we cover property transactions. Okay, I also said Schedule E, I was going to go over. Schedule E is for what? Anybody know Schedule E? Nobody knows? Schedule E has several purposes. It's for rents, royalties, and pass-through income. Now, the pass-through income, if they get K1s from S corporation, partnership, or trust, it gets reported here first, and then it flows to it goes here first, and then it goes to whatever form it's supposed to go on. What the heck? That's the instructions. I'm not looking for the instructions. Here it is. All right, here's a, rental property goes here, also vacation homes go here as well. This information should be filled out, federal rental days, personal days. Now, usually the federal rental days should be 365, generally speaking, if it's full rental. But when it comes to vacation homes, this is where you enter the information in here. Type of property, look at the instructions on the type of property, single property, multifamily property, that type of information. Again, listed by different types of property. If there's more than one, again, more than one rental property A would be here, B here, and so forth. Pretty straightforward. It also has a page 2. Yeah, remember I told you page 2 is where this is the part of the reporting structure for K1s. So here's where the K1 information would go. The name of the S corporation, trust, or partnership. Fill this information out. Passive income, non-passive income. That information would be here. If it's interest dividends, that goes straight to 1040. And these numbers would go straight to 1040 as well, depending on the circumstances. Now, on the bottom, there's a section for real estate professionals. Not all real estate individuals are real estate professionals. And you can't just say I'm a real estate professional because you want to be a real estate professional. You actually have to fit the criteria. We'll go over that in more detail later. So that's Schedule E. One more form, and then we'll go back to the lecture. Form 4797. Form 4797 deals with property transactions, sale of fixed assets. That's what we're going to deal with a little bit later, but I do want you to be familiar with it. Again, this is when they're selling fixed assets. Again, usually most of it is going to be on this page, page 2, because this deals with the recapture provisions, 1250, 1245. This pretty much walks you through the steps that we're going to go over when we touch on that particular chapter. Okay, that's it for the forms. There's a lot more forms. Again, I'll go over those forms in more detail later. Any questions on tax forms? Any forms you guys want me to talk about or don't want to talk about? All right, let's do some problems. Chapter 6. All right, so I also sent you the practice quiz, which we're gonna go over Wednesday. The practice quiz we're gonna go over Wednesday.
A question on the text project. So since you said we should be using 2019 text forms, we should go
Right.
into all the data and change and add
You're
one
right.
more year to everything.
Yeah, you're right. I'll do that. I'll do that before I leave. Yeah, thanks for that revised tax return. I'll revise it before I leave today. So yeah, that's a good point. Yeah, if you already started working on it and I want you guys to already look at it, at least do it that way. Just if I told you, I think he got divorced in 2018, so just say he got divorced in 2019, and the alimony payments didn't start till. So my facts I had is the alimony payments. When did they start? I don't know if they started the current year or the next year. If they started the next year, 2019, then just add a year. You're right. So it's I gotta double check, but yeah, just add a year if you already started working on it. I'll revise it. But yeah, thanks for catching that. All right, before we get into this problem, there's one problem in this book that has where we're separating deductions for AGI, deductions from AGI. I don't know if it was this chapter or the next chapter. Oh, here goes the problems that we're gonna do in a few minutes. These are pretty good. The vacation home problems. No, it's not here. Let me. It's in chapter 7. I think this would be a good question to start with. Chapter 7. Come on. It's not here. I can't find that question. That was a question that's just gave a list of different deductions. I thought it was here. And then they ask you to identify if it's a deduction for AGI, deduction from AGI. Or not deductible. And maybe it's not here yet. Maybe it's in chapter 9. Maybe they moved it. Well, you know what? Let's go to chapter 6. I can't find it right now. I don't know where it is. Yeah, let's do chapter 6. Let me. Yeah, it's not there. Yeah, that would have been a good problem to at least what if it is chapter 9? It used to be in the earlier chapters. So this problem just gave a list of different deductions. Good. It was a good problem because it allowed you to, test your knowledge on where does it go deduction for AGI, from AGI or not deductible. Here it is. It is chapter 9. You guys see it? Oh wait, it's moving slow. I see it on my screen. There it is. Again, we're going to revisit this one. We're going to walk through this. I want you to think about where would it go as deduction for AGI or deduction from AGI. So the first one, tax preparation fee incurred by an employed plumber. Where would this be deduction now under current tax law? Anybody? What do you guys think? I'm gonna start calling on people. Let me see.
Not deductible?
Yeah, it's not deductible. Where would it go before? Where the correct answer is not deductible. Prior to
From?
20, yeah, it would be prior to prior to the new tax reform, it was an itemized deduction subject to the 2% AGI floor, but now it's not deductible. So good. Safety glass purchased by an employed pipe fitter under current tax law. What do you guys think? Matthew. Under current tax law. Not deductible. Now, if you're saying that it automatically, and this is one of the reasons why I went over Schedule A previously. Where would business employee expenses go? Nowhere. I didn't go over that form because it's not there anymore. Where would tax preparation fee go? It's not there anymore. Production of income deduction, it's not there anymore. So again, that's the whole purpose of this. You're going to find out that pretty much all of them are not there anymore. Dues to, actually, we're going to skip this one because I got to go over the mileage method for you to understand this. Even letter D, it's not deductible because you think, not because you think. Well, sort of going over this. A nurse refresher course for a taxpayer who retired from nursing 5 years ago. Yeah, in that case, it's not deductible. But if it's just part of continuing education, this person is an active nurse and it's just continuing education, it's still not deductible, right? Deductible because they're an employee, right? Gambling losses not in excess of gambling gain by a self-employed architect. So gambling losses, deductible from AGI, right? Limited to income. Contribution to a Roth IRA by a self-employed attorney. We went over this one
Or
before.
AGI?
No, it's a Roth IRA. No, you're on the right track when you said for AGI, but I gave you a hint. This is a Roth IRA, not a traditional IRA. Do not automatically assume that all IRAs are deductible for AGI.
Gotcha.
So that again, a Roth IRA, as I mentioned before, we went over this discussion before. Contributions to the Roth IRA are not deductible. So what happens when you pull the money out? Generally, that's tax-free. Generally, that's considered tax-free. So that's not deductible because there is no deduction for it. Oh, this one, letter G, is deductible, but it's a bit misleading. Wait, I'm sorry. Letter G, statutory employee. Statutory employee, they can put their deductions on Schedule C, deduction for AGI. But not all employees are statutory employees. Statutory employee, that's sort of a employee that has attributes of both. They probably would have been a self-employed an independent contractor, but they're under certain state laws or whatever that requires them to be an employee. Think of this as a lot of personal people that sell insurance fall into this category. People that sell not just insurance products, financial planners, so to speak. A lot of financial planners fall into this category, but you can't automatically put them in this category. Their W-2 has to have that statutory employee box checked, and then it'll be a deduction for AGI. So that's the only employee that can take that deduction right now. Job hunting expense by an elementary school teacher seeking a position as an elementary school principal. Not deductible because it's a new profession. But what if it was job hunting expense in general? Still not deductible because that whole line item got removed. Cost of the bar exam review course taken by a recent law school graduate. No deduction. What about CPA review course? Sorry. CPA review course not deductible as well. No, sort of. It all depends, but generally speaking, no, because that's not necessarily required. That's not part of your degree. It's not any education at all. All right, yeah, we're going to revisit this particular question when we deal with chapter 9 in a couple, well, next week. But let's go back to chapter 6. The question that I do want you to know, the self-employment, well, not the self-employment problems yet. We're going to do vacation home problems. Um, all right, we'll do 34 in a little bit. I'll show you what the answer is a little bit. Sort of think about this. See what information is. Actually, I can give you the answer in a little bit. I'll show you the answer, but let's walk through this. Again, there's a lot of these problems from this point forward will be comprehensive, so you have to use all your knowledge that you've learned so far, and this is actually one of them. Salary, that's considered income. Net rental income, that's income. Dividend income, that's income. What about this payment of alimony that was finalized in 2019? Can he get a deduction for this? It was finalized in 2019, after 2018. Can he get a deduction for this? Yeah, and this is where you need to pay attention to the dates. What do you guys think? I'm sure I gave you a date on this one. Anybody? Margaret, what do you think? Deductible or not?
I know the cutoff is the 2018, but I don't remember whether it's deductible or not. I'm sorry.
Well, okay, what's the cutoff for? I mean, you're on the right track. What's the cutoff for? It's a cutoff for a reason.
Isn't it a cutoff for who gets to deduct it?
For both, it's not income to the recipient and there's no deduction to the person paying it.
Yeah.
So what is this? No deduction, right? If the alimony was finalized in 2017, deduction, right? If the alimony was finalized in 2018, right? Who put no deduction on the side? That's good. How do you take that off? I don't know who did that, but whoever did that, that's great. I need to learn how to do that. That was annotate, right? I can use the annotate. I'm not gonna annotate, but you guys can do that. All right, no deduction there. Mortgage interest on residence, itemized deduction, right? Property tax on residence, itemized deduction, right? Contribution to a traditional IRA, deduction for AGI, right? Contribution to church, United Church, that's a 501c3 organization. That's a deduction from AGI. Loss on the sale of real estate, held for investment, not personal. This is a capital asset. Capital loss, right? Capital losses are deduction for AGI, right? Medical expenses, deduction from AGI, itemized deduction, right? State income tax, itemized deduction. Federal income tax, we apply that against your taxes. So we got to figure out what's the deduction from AGI and deduction for AGI. So let's highlight, okay, mortgage interest from AGI, right? Property taxes from AGI. Contribution to traditional IRA for AGI. Contribution to United Church from AGI. Loss on the sale of real estate for AGI. You guys see what I'm doing here? I'm just identifying what's an itemized deduction. Remember, the itemized deductions are from AGI. That's how I want you to start thinking. It's really not that complicated. Just start thinking, is there deduction allowed or under what's code? And does it fall within the category of itemized deductions? If it's an itemized deduction, then it's a from AGI. If it's not part of itemized deduction, but it's still a deductible loss, then it's for AGI. So just keep that in mind. So here's the answer for 34, so you guys can see it. All right, it's taking a second to open. Give me a second. I don't know if I posted this one on Brightspace. That was question 34, right? Oh no, it's thunder. That's not good. All right, here's your answer. Take a picture, snapshot or screenshot. Okay, you guys see it, right? Gross income, we figured that out first. Salary, rent income, dividend income. Again, that's step number one, to figure out gross income. Then we figure out the deductions for AGI. Alimony paid, yeah, that's not a deduction, as we talked about it before.
We can't see it.
Oh, sorry. Here we go. All right, give me a second. Okay, there. All right, there it is. All right, again, we walked through the steps before. What's the salary? Salary, that's gross income. Rental income, that's income. Dividend income, that's income. So step by step, gross income minus deductions for AGI. So we figure out whatever's in gross income, then we subtract the deductions for AGI. Alimony paid, remember I said no longer deductible. Contribution to traditional IRA, deduction, right? Loss on the sale of real estate, that's a capital loss. The most they can deduct is $3,000. It's $2,000 loss. So 69,500 minus 7,000, their adjusted gross income is 62,500. That number is relevant because we need that for a couple floors. Medical expense floor, which they got the 10% floor. That should be 7.5% now, but nonetheless, it's still under the floor. State income tax and property tax, that should be grouped into one section. So 1,200 plus $300, $1,500 in taxes. Remember, I said that's limited to 10,000. So just keep that in mind. Mortgage interest 9,900, and then the charity, so 13,500. So can we take? What would we take here? If the standard deduction is 12,200, itemized deduction is 13,500, what do we take in this case? Everybody should know the answer to this. Itemized deduction, right? So itemized deduction, 13,500, 62,500 minus 13,500, that gives them a taxable income of 49,000. You figure out what the tax liability is on that, and that you use the $7,000 to determine if there's a tax due or not. Pretty straightforward. Okay, any questions on that? Take a screenshot if you want to take a look at the answer. All right. Let's move on to the next one. Okay. The next one I want to do is actually, these are pretty interesting. Let's do 39. I don't know if I actually ask you this to do this, but this is a very interesting one to think about. All right, so Flynn paid the following expenses for 2019. $50 for a ticket for running a red light while he was commuting to work. Is that a deduction?
No.
No. $100 for a ticket for parking in a handicapped parking spot. No. $200 to an attorney to represent him in traffic court for 2 tickets.
No.
No. $500 to an attorney to draft an agreement with a tenant for a 1-year lease on an apartment that Flynn owns. What do you guys think of this one?
No.
Well, no, again, bigger picture. He has rental property. Isn't this part of the rental property?
Yes.
Why wouldn't this be deductible? I'm paying an attorney to draft some a lease agreement that I have with my tenant. If you have a loss or not, it doesn't matter. It's a deduction. You know, it's pretty straightforward. This is in the course of doing business. Just put it this way: if it's in the course of doing business, why would it not be deductible? If it generates a loss or not. If it generates a loss, then you have to see if it's a net operating loss. If it doesn't generate a loss, it's still a deduction. $1,000 to an attorney to negotiate a reduction in child support payments. I'll give you a hint on this one. This relates to child support, which has no implication on taxes at all. What do you guys think?
No.
No. What about this one? $2,500 to an attorney to negotiate a reduction in alimony payments to a former spouse. Let's assume that the alimony was finalized in 2017, 2015, some other
Yes.
year. So yes, that's part of tax planning. If you think about it, it's a tax strategy. Assuming that the alimony is still deductible or it was finalized, then in that case, yes, it'll be a deduction. But just keep in mind like when it actually occurs. So that's on a case by case basis. All right, so that's it for this one. Let's do the vacation home ones. The vacation homes are actually pretty interesting. And where's the first one should be here. Here it is. All right, the 47. All right, so this is from a 47 winter resort that's rented for rented her personal residence as she lives in a winter resort. She rented her personal residence for 14 days when she was in Brussels. Rental income was $5,000. Then they have a whole bunch of expenses. What is the effect of her AGI? You read my mind. Well, if it's rented for 14 days or less, it's not income, right? So no business deduction. So you're right about that. So what happens with the real estate taxes and mortgage interest? That's personal, right? Can you deduct property taxes and interest on your personal tax return? Yes, that's an itemized deduction. So what effect does this have on her AGI? You're right, nothing. No income. What effect does it have on her taxable income? To the extent that she can itemize, these two numbers right here would be part of her itemized deduction. Everything else is not considered an itemized deduction. Pretty straightforward, right? 47, straightforward.
So is it just considered like a personal residence at that point?
Exactly.
Okay,
Yeah,
so
that's
you
a good
just do
point.
what you normally do for your own home.
Yeah, you do what you normally do for your own home. You put it on Schedule A. Yeah, it's a second home. Put it that way. It's a second home.
Okay.
So you can't deduct utilities, insurance, repairs, depreciation, only interest and prop. So yeah, it's the same thing as an itemized deduction. Just it goes into that group in that Schedule A, what I just went over. So yeah, 48. Now this one's actually a bit different.
I
During
have a
the
question. I'm sorry. I have a question on the previous one. What happens to
sir.
the income of the $5,000? The rent income.
What about it?
Does it get added to her?
Where would you add it?
To her
Right.
net income, and she will get taxed on that, no?
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 Matthew, can you go back to that explanation that you just said? I think that was you. No. No, you were not. No, it's not income. Here, let me go back to my notes when I went over this. This is gross income and gross income exclusions, and this is a very important concept. It's think about it. It's in the code. It's section 280, capital A G. Hold on. Let me share a new screen real quick. I think it was in gross income exclusions or inclusions. Here we go. Remember when we went over this a few sessions ago? You guys see it?
Yep.
Again, the relevant code section it is under section 61. Nothing's in gross income. The specific code section, it is under section 288 that talks about the under the 15 days or 14 days or less, the income is excluded. And then no deduction. So again, remember this particular table. And also remember the table on the bottom. This is the reason why I put these two together as it relates to arrangements. But if it's now, what happens if it's 15 days or more? Then you do recognize it as income. Then what happens to the business deduction? You get a business deduction, but now you got to determine if it's a vacation home or not. And then I think I also had it in in this one. I think I also put it here. Where did I put 4, 5? Where's 5? I put it in my discussion on the vacation home. So look at those particular notes. I can't find it. Oh, here it is, 5. Let me pull it up real quick so you guys can see. But it is section 288. And in terms of the vacation home, again, I'm bringing the notes back from, here it goes. Again, vacation home. Again, I want you to take a look at this again. Actually, let's revisit this since we're on the topic. A vacation home is when a personal days are greater than 10% of rental days and greater than 14. Again, here are the bullet points again. Rented less than 15 days, rental income is excluded and expenses are treated as personal. You can only deduct interest and taxes, right? Rented 15 days or more, tax preparer needs to determine if vacation home or rental property. You run through these tests, but this is all you're really doing here. Is if the personal days is more than 10% of your why did it do that? Again, if personal days is more than 10% of rental days, you don't have to run through this test, but it does help. And you go through these expenses: mortgage, interest, and taxes, other expenses, depreciation, no net loss. Again, whatever is not allocated to the vacation home is personal. Whatever is allocated to the vacation home and not deductible is carried over to the future year. Remember this particular equation. We're going to walk through this, in a few minutes. All right, let's go back to. All right, so everybody okay with this? With question 47, it's not income. $5,000 is excluded. Everybody
Yes,
okay with
thank
that?
you for going over that. I missed what happened to how the income would be treated. Thank you.
Well, no, that's a good question. It's where to go. So it's again, it's because it's rented, for less than 15 days or 14 days or less. Income goes nowhere. Actually, it doesn't go anywhere. Not in this case. Not in this case. Interest and tax. The property tax 3,800. Mortgage interest 7,500. That gets added to her itemized deduction. That's it. Okay. Nothing else, and we don't do anything with the other information. Now for 48 I'm actually glad that you asked me that question, because now it brings it to the next question. So 48, during the year, which is not a leap year, so we're going to use 365 days as the bottom number under the tax court method. She rented the vacation home for 30 days, so it's more than 14, right? So if it's more than 14 or 15 days or more, it is income. But we have to figure out if it's a vacation home or rental property. By the way, if it's a vacation home or rental property, what form does it go on? I showed you this form a few minutes ago. Schedule E. Yeah, it eventually goes on 1040, but it goes on Schedule E. That's where you do your computation. Schedule E, page 1. So rental income is income because it's more than 30 days. Is it a is it a vacation home or is it rental property? Well, again, if personal days is more than 10% of rental days, and if personal days is more than 14, then it's a vacation home. Personal days is 20, right? That's more than 14. Okay, so that criteria is met. Is 20 more than 10% of your personal days? So 10% or 10% of rental days, I mean. Rental days is 30, right? What's 10% of 30? 3. Is 20 more than 3? Let me ask you that again. Personal days has to be more than 10% of rental days. Personal days also has to be more than 14. Is that true? Yes. 20 days is more than 14, right? Is 20 days more than 3? Come on, everybody. You guys should all know this. It is true,
Yes.
right? So that makes it a vacation home. Because it's a vacation home, now we got to allocate the expenses, interest and taxes, one group, other expenses, another group, and then we have to figure out if there's any loss or not. All right, so the fact that they left it vacant for 315 days, that's irrelevant. That's people like to say that, but that really does nothing. All right, let's group the expenses. So the first category that we're going to see, it's 11,500. You guys see that, right? Category 1, interest and taxes. So 2,500 plus 9,000 equals 11,500, right? That's category number 1. What's category number 2? Category number 2 is other expenses. That's not depreciation or the first category. Other expenses, 2,400, and repairs. So other expenses, 3,400. Are you guys with me so far? First category, 11,500. Second category, 3,400. What's left over? 7,500. What happened to this roof replacement? Section 263, you capitalize it, right? And depreciate it. I'm assuming that the $12,000 is included with this depreciation number. So that's not deductible. The $12,000 is not deductible. It gets added to the cost of the depreciation as part of the depreciation. So we have to figure out using the IRS method and the tax court method. And then what you answer, yeah, it will change. All right, but let's do 49 very quickly. So, 48. 48, I think I gave you this answer, if I'm not mistaken. So 48 is there. But the way I have it I'll show you the way I have it, and I'll show you the way the book has it. I like to present it in a spreadsheet format, and that's how I want you guys to, get used to it. All right, hold on. Come on. Now my computer froze again. Let me try this again. All right, we're using the IRS method first, right? All right, can you guys see it? Again, this is on Brightspace. The solution is on Brightspace. So $7,000. Remember, I said the first category, 11,500, which is taxes. What is the ratio we're using? Days rented goes on top, right? 365 goes on the bottom. So 11,500 times the ratio of 3 over 365, only 945 gets allocated to the vacation home. So of the 11,500, 945 is a vacation home. 10,555 go to personal. That's an itemized deduction. Everybody okay with me on that one? We're allocating 945 to the vacation home. The rest is an itemized deduction. Everybody okay with that? Okay, other expenses. That was the utilities and repairs, right? 3,400. That ratio is days rented on top over total used days. Remember, they use it 20 days for personal, rented for 30 days. So the bottom number should be 50. So 3,400 times the ratio of 30 over 50. So on the vacation side, I'm allocating 2,040. So of the 3,400, I'm allocating 2,040 here. The difference, 1,360, it's personal. Can we deduct utilities and repairs on a personal property? No. Section 262. Depreciation. Remember, that's 7,500 times 30 over 50. I get to 4,500, but I'm not going to use the 4,500. I'm going to use a lower amount. But again, I'm supposed to use 4,500 here, right? But I'm only using 4,015, but I'm supposed to use 4,500. Since I'm using 4,500 in my vacation home, what's left over? 3,000. The 3,000 is not deductible because you can't deduct depreciation on your personal use property. 14,015 is deductible to the extent of income. So in this case, of the 4,500, they're not using 485 of depreciation. Where does the depreciation go? It gets carried over for next year. So in this case, what's the only impact on adjusted gross income? Well, there's nothing impact on adjusted gross income because you still get zero, right? But on a itemized deduction, they're able to increase their itemized deduction 10,555, right? Any questions using the tax court method? You will have to do this on the midterm, by the way, and perhaps the final.
What happened to the 12,000? I thought we were going to add it to depreciation.
Yeah, it's already there.
Uh,
It's
Is
there,
that-
but it's not there. Well,
is that what depreciation is for then?
that's what depreciation is for. So here's the thing. The thing is, the reason why they put that in there because they wanted you to test you on just the concept itself. You know, the basic concept. If I buy a fixed asset, what do I do with that fixed asset? You don't do anything with it. You depreciate it. What you do in practice, yeah, you will recompute the depreciation. But the way I read it, that the 7,500 already included the depreciation. But let's say in your case that $12,000 was an additional asset that's not part of the depreciation from prior year. Then you just add it back to the depreciation, not the full 12,000.
The amount that's being depreciated?
Whatever gets depreciated, right?
Yeah.
You know, you're going to depreciate it over. In this case, you know, it should be either 27 and a half years or 39. Most likely 27 and a half years. In this case, it's a residential property. It's 27 and a half years. It gets depreciated over 27 and a half years, unless another provision applies. But 27 and a half years is usually what it would be. So that would it be if you, I guess, look at it, the 12,000.
That makes sense. I understand what the buck was saying now.
Yeah. So again, it's an additional $400. They're just testing it just on if we deduct it or not, or just classify them as a category, so it doesn't go anywhere. Okay. Any other questions on this part? And I want to encourage you guys to do this in practice. Do the same one, the one that I did and last week, the practice problem, and this one. Now, the continuation of the problem is asking us to do the IRS method. So before I show you the answer, what's the only thing that's going to change? Just this equation, right? Interest and taxes. It's going to be over 30 over 50. So this is going to change. The bottom number, 1363,000, was these two numbers will stay the same. These two numbers on the left-hand side will change. But the main idea is the itemized deduction changes. Here's your answer for the tax court or the IRS method. So in this case, I'm allocating more to the vacation home, right? Less to personal. So 4,600 here, 10,005. Which one benefits the taxpayer more? This one, right? You know, which one benefits the IRS more? This one. Again, it generates revenue. So looking on this side, remember, these two numbers don't change. For other taxes, other expenses and depreciation, you know, these two numbers don't change. It's just what gets allocated to the personal changes. The carryovers numbers, you know, change. Because we're using 6,900 here, it only allows me $100 for the next, category. So here's a full explanation. So even though 2,040 of other expenses is allocated to the vacation home, only $100 is being used. The excess 1940 is getting carried forward. Same thing for depreciation. The full amount, 4,400, is going to get carried over to the next year. So what changed? Net income is still zero, right? What changed in this circumstance? Itemized deduction. You guys see now why the IRS would like this method, right? It has a potential to raise more revenue because fewer people are itemizing it. I should say fewer people are claiming it as an itemized deduction. However, because fewer people are itemizing now, you know, something to think about. You know, you may actually the IRS method may be better. No, I didn't say that. Always use the tax court method unless it makes sense to use the IRS method. Yeah. Exactly. So that's a good point. So in this case, it is a significant difference. It's $6,000. Good point. Yeah, it's approximately $6,000 difference. So that, yeah, then in that case, it would make a difference between somebody itemizing or somebody not. So again, I guess with that, to Matt's point, I guess it's facts and circumstances. I always say go for the tax court method anyway. At least it gives them the potential to itemize more, and that way they can actually see that you're for them, for the taxpayer, not for the IRS. Because if you use the IRS method, you're actually saying that you want the IRS to have more money. Again, that's fine. That's a government, but they got to find ways to make more money. As we went over today, the Congress did at least found ways for taxes to go up, or to certain people pay taxes. So that's still true. In this case, yeah, it does make a difference. $6,000 will make a difference. But let's say in either circumstance, they're still under the threshold. Let's say they're married, and if you use the tax court method or not, it really doesn't make a difference. Again, something to think about, but it's on a case by case basis, on this. All right, let's do. It's plus 48. Let's do 49. I guess I do have the answer for 49. But think about 49. Think about this for a second. How would your answer to problem 48 change if Anna rented the house for 87 days? That's more than the 14 days, right? So it's rental income, but she used it personally for 13 days. What's the right criteria for a vacation home? Again, and this is where I'm going to go back to this again. I guess this would be a time where this type of table would be useful, sort of, in a way. Okay, so right here I said determine the personal days. So what's the personal days in this case? 13, right? What was it, 13? In this problem, was it 13? Let's say 13, right? Was it 84? Wait, no. 9? Was that it? Let me go back to the problem.
87.
87. Still 9, right? 10% of 87, 9, right? That still works, right? All right, so is 1 more than 2? 1 is more than 2, right? Is 1 more than 14? No. What do you have? Section 4, rental property, right? Section 469 applies. You don't have a vacation home now. Now you have a rental property. So again, 13 is more than 9, but 13 is not more than 14. This person probably, well, depending on what they wanted to do, maybe they wanted to have it as a rental property. So this is not a vacation home, it's a rental property. Now, the allocation for rental property, the US tax court method is not allowed. It's just a straight ratio, 13 over 100, so or 87 over whatever the ratio is. So 87 days rented, right? Right? Over 100, right? That's how it would be. So that's how you would do the ratios. Now, in terms of the expenses, well, I'll show you the answer real quick. Same set of facts, except it's a rental property. By the way, with this particular problem, I know I have the tax court method as a separate tab. Ignore the tax court method. Again, for this particular problem, it's just IRS method. That's the only thing you're using, the IRS method. So it gets a bit tricky here. Keep in mind that they used it for personal less than 13 days. So this is what happens in this case. So it's allocated by 87 over 100 for everything under the rental side. From the personal side, it's the reciprocal, 13 over 100. So 87 over 100, 10,005. Deduction for AG as a rental property. Other expenses like 2,900 and change. Depreciation 6,525. Whatever is left over is personal. Notice I have non-deductible for all of them. I'll explain to you why in a few minutes. But everybody okay with me using the same ratio for all of them? Pretty straightforward. I have a net loss of 12,444. Can I deduct my loss? Well, it all depends. I haven't covered this side of it yet. There is a rental loss of 12,448 that may be deductible if the taxpayer actively participate and if Maggie is less than $100,000. Or there's real estate professional rules, which we'll go over in more detail. So there's a chance that the 12,488 is a deduction for AGI if they actively participate in the rental activity. And chances are with that amount of activity, chances are that they did. However, because the taxpayer only used the property for less than 14 days, in other words, they did not use it enough for it to be personal. In order for it to be personal, it would have to be 14 days or more. Then the itemized deduction kicks in for the $1,495. In this case, because it's less than 14 days, it's all rental. Well, not all of it. 87 over 100 is rental. Whatever's attributed to the personal side, that's not deductible. Okay. This is, the answer for this one.
Just a quick clarification. Isn't it because it's used for less than 15 days? So if they use it for only 14, that's still not enough days. It has to be 15, right?
Okay. If it's less than 15 days, again, if it's 14, yeah, that would make actually a good point right there. If it's 14, that would be 1 day. That would be fine.
The other table said that it had to be more than 10%.
No, actually, yeah, you're right. It is, again, personal days, it has to be more than 10% of rental days, and it has to be more than 14. You're right. So then it has to be 15 days. So if it's 14 days, then it still wouldn't work. You're right. It still wouldn't work at 14 days. So it would have to been 15 days. It has to be, again, yeah, it's the 14 days, it's more than, so I see what you mean. It goes back to, let me go back to this one real quick.
Are we using the IRS method here? Or is it just over 100 because we're doing rental property?
Well, it's always the IRS method for rental property. Remember,
Okay.
vacation home, it's the only time that under the vacation home, that's the only time you can use the tax code method, only on the vacation home. Rental property, you're just allocating it by the ratios personal over, you rent it over total. That's what you're doing here, which is 87 over 100 days.
And then nothing's deductible for interest and taxes.
No, because it's the 14-day, threshold kicks in.
You really want to stay at your rental property for a little bit to make it a vacation home? Because I feel like it changes quite a bit what you're able to deduct.
Well, it depends. It depends on there's a lot of, there's no way I can answer this question. Well, I don't have all the answers.
Yeah.
Let's think about this. You're right if you want it to fit into the vacation home. If you want it to fit into the vacation home and you want the taxpayer to benefit from an itemized deduction, then it works. Now, in this particular circumstance, let's say you want it to fit into the rental property deduction for AGI, then it works depending on what the taxpayer,
Oh, yeah. I understand what you're saying.
So just think of it this way: is it better to get a deduction for right here? Remember, vacation home, no loss. Assuming that it does qualify for rental property, there may be a loss of 12,488 that may be deductible. So just keep that in mind. That 12,000.
Yeah, I wasn't thinking about the loss. Yep, that makes
So
sense.
I guess one way of looking at it is well, in this case, you're right. We're not taking it as personal deduction, no itemized deduction, because we didn't use it personal, sufficient enough. But okay, so we don't take a personal deduction, so that's like a $10,000, close to $11,000 right there that we're losing out. But what's the other side of it? But then we're also taking, to the extent that we qualify to take a deduction for rental losses, then we take it here. So it's again, I wouldn't, like something like this, you do need all the facts and circumstances. You can't just do it by, if you're trying to see what would benefit more, and you're doing tax planning, again, it all depends on what you're trying to accomplish. If you're trying to maximize their itemized deduction, try to see if the vacation home will work. If you're trying to see if they're at a rental loss, then rental loss will work. But what if their adjusted gross income is over $100,000? And this wouldn't work at all. Fitting into rental property will not work because it's disallowed anyway. It's phased out anyway. Then you want to see if it's a vacation home. But keep in mind, these are the facts that are already given. You don't change the facts. This is something that you'll do during I guess around this time. When you're planning. When you're planning for your clients, you want to talk about different tax planning strategies during the year, and something like, well, how about you stay in your house 2 more days? It sounds funny, but it's not. It's like, again, this client comes to you. Well, I rented my place 87 days, my vacation home so and so, but I only use it 13 days.
Well, I have a question about what counts as.
But actually, with that, it does sound funny, but it's a simple advice. Just say, well, if you rented more than 15 days, it's now a vacation home. It works.
Well,
So
I have a
sometimes
question.
that's all it takes. One more thought. And I have a friend who he used to do this a lot. He would call me just to go out drinking, and this is the way he would try to write it off on his. And actually, and he did. I'm his CPA, but we would talk about sports, politics, catch up on everything. And then during the meeting, because he always knows that we have to talk about business, and he's always saying, "I'm going to take my accountant out," and he picks me up at my office. We go to like a bar nearby, drink and talk about sports or whatever. But before the night is over, and he does all kinds of investment, he makes sure to always ask me at least one tax question. I'm serious. He just asked me one tax question. Again, he has property like this. Sometimes he'll ask me a simple question like something like this: would it make a difference if I use it for personal? It's simple as that. There was even one time that he asked me. I'm not lying. He was telling me, so my wife and I are thinking of having kids. What are the tax benefits under the current tax law that we'll have if we have another kid? And I guess he knows how I am. I get into detail. I start talking about this and that, and as soon as he gets me going, I start talking about tax law. He's like, okay, I can write it off. That's enough. And then we're back to talking about whatever. It sounds a little funny, but sometimes that's usually how meetings are. So sorry for going on a tangent, but go ahead with your question.
So, what qualifies as personal days? Does it have to be the owner there specifically, or could a relative use it? So, like, oh man, I need a couple more personal days. Hey, son, you want to go take your siblings up there for a couple days? Does that count as personal days?
Well, I see. Again, with immediate family, yes. But the other side of it, if you start telling friends, and then yeah, it all depends. And it's immediate family, you can say yeah, you stay there too. It's yeah, it's much better if you make an argument if you have your immediate family go there, and then if you start having friends go there. If you have friends, they're not personal. It's different. And then the other side of personal, it's another thing you can also argue. You don't actually have to use it the full day. You can actually go there one day, and let's say maybe do some repairs, clean up, just check the mail. Oh, you used it, for a personal day, and that will count for your personal day. So just keep that in mind as well. And I guess the other side is, I guess you could tell your kids, hey, why don't you go over there? I need one more personal day. But short of that, you can't tell your buddies, to fill in the spot for you, because then it won't really count. But if it's your kids, that should count. That's personal. But anything short of that, wouldn't count. So you can't tell like you're not even as your significant other unless you accompany them, then that will count. I guess you can take your significant other, leave your spouse at home, type of thing. That may work. That was a joke. I'm not, condoning that type of
I have
behavior.
one other question about this. So well, first, so you said that the net loss would be a deduction for
Yes.
AGI?
Yes.
For AGI. So then could you deduct that for AGI and then take the standard deduction from
Yeah.
AGI?
Yeah,
Okay.
remember the standard deduction. It's either the standard deduction or itemized deduction.
Okay.
Again, we don't have all the facts. In this case, I'm assuming they will take the standard deduction. We don't have enough facts to determine if they have enough to itemize. But yes, you'll take the standard deduction or the itemized deduction. Remember
Okay.
now, in terms of the the two types of taxpayers that are not allowed to take the standard deduction. We went over this the first week. Individuals that use married filing separate and the other spouse itemize, that spouse, they can't take the standard deduction, so they're forced to itemize. if you're considered a non-resident alien for tax purposes, you're not allowed to itemize. Well, you are. I mean, you're not allowed. You're not allowed to take the standard deduction, but you are allowed to take the itemized deduction. So look at it on facts and circumstances. If to the extent that they're allowed to take the standard deduction, then you take the standard deduction. If they're not allowed to take the standard deduction, then it's just going to be zero. So something to think about. But just put it this way: everybody takes the standard deduction, except when they itemize. Again, the only two people that don't take the standard deduction, Mary Fanny separate, and the other spouse itemizes. Or if you're considered a non-resident alien for tax purposes, then you have to take zero or your itemized deduction. So that's how that works. So yeah, good question. Remember, deduction. The only thing that's a deduction from AGI are your itemized deduction. Deductions for AGI. This would be a deduction for AGI. I think that's any other questions on this one. I think we sort of again. I got the tax code method again, not applicable here. I just use the same spreadsheet, but this is what I want you to look at. The next question that I wanted you to see is a continuation, but I guess we can do this next week maybe. Well, we can sort of start talking about this one. Question number 50. Give me a second. It's loading. Okay, there it is. So with this one, actually, I'll show you the answer for this one because this is a very good one to go over. Again, salary, so for municipal bond interest, that's not income, right? Dividend, that's income, right? And now in terms of the rental property, so let's say the rental property, they rented it for 16 days, personal for 60. So 60 is more than 14, right? And then and then 60 is more than 6, right? So we got a vacation home. Everybody okay with that? This is definitely considered a vacation home. So $4,000 is income. We have to figure out the vacation home expenses. All right, so vacation home expenses, interest on the vacation home, 4,758. We're going to see if that's deductible using the ratio. Interest on the mortgage interest on the mortgage property. I'm assuming that's her first home. And interest on municipal bonds, no deduction, right? And the other side of it, there's additional information. Property taxes, that's an itemized deduction. Property tax on the vacation home, we have to figure that out. How much is allocated to the vacation home? How much is personal? State income tax, itemized deduction. Sales tax, you can't get both. It's either state income tax or sales tax. We're going to go with the higher number. Charitable contributions, that's deductible. Tax preparation fee, no longer deductible. Utilities and maintenance on vacation home, that's deductible. Depreciation on the rental portions, they already did the depreciation. All right, so I'm going to walk through this tomorrow on Wednesday, so you guys can see it as well. But just let's see. What question is this? Question 450, right? All right, let me share the screen real quick. All right, if you want to see the answer real quick according to the book, again, they presented it slightly different. Again, take a screenshot real quick of, again, this is 48. Again, the first one, pretty straightforward. There's no income. You want to take a snapshot at that. Again, they have it presented differently, but the numbers are still the same. Again, this is 48, the question 48, we've already went over. 49, again, I presented it slightly different. It's, so it's presented slightly different. Again, same thing here. It's giving the explanation as to why none of the personal is deductible. And all right, so 50. Yeah, either way, they're actually at a zero net loss. All right, let's actually spend some time using the tax court method. Again, 60 over 365, so 5,856 is of the 5,856, 963 is allocated here, right? So 5,856 minus 963. That's how we got the 4,893 on top. That's an itemized deduction. You guys see that, right? That's how we got the 4,893 on top. We did the tax core method first, and whatever we don't allocate here goes as an itemized deduction. So over here again, utilities and taxes, 60 over 120, we're only allocating 1,300. The other 1,300 is not deductible. Depreciation, 3,500, but it's only limited to 1,337. The difference gets carried over till next year. Again, let's go back to this. So rental income and vacation home, 0. You can never have a loss. So 43,000 plus 400, adjusted gross income, 43,400. There was no deductions for AGI, but we did have itemized deduction. State income tax and property taxes, plus whatever is allocated to the taxes from here, should limited to 10,000, but it's way below the 10,000. Interest on first home, that's deductible. Interest and property tax, they just put it as one line item. That's the difference between the 5,856 and the 963. And then charity, 1,100. Total itemized deduction, 19,893, because that's more than 12,200. We're taking the itemized deduction, right? Okay. Again, there's the additional explanation, but this is pretty much the meat of it right here. And take a snapshot, screenshot, or however you do it of this real quick. And I do want to take a look at it. Next week we'll touch on this one next week. Continuation, this pretty straightforward. State income tax is greater than sales tax. Tax preparation fee is currently not deductible, as I mentioned. Any questions with this one? Again, the next step, you just take that number, look it up on the tax table, or use the tax rate schedules. No questions at all? Questions on anything else that we've covered so far? Nothing? So this is the time that you guys should be asking questions. Again, the midterm is going to be a week from today. Now, as far as the midterm goes, next Monday, we're not going to meet. Next Monday, I'm going to leave that whole day open for you to take the midterm. The midterm is going to be a time midterm. It's time limited to 3 hours. But you will have the whole day to complete it, meaning you can take it in the morning, you can take it in the afternoon, so long as you finish it within 3 hours. It got more than enough time. Next session, we're going to go over, and in case I forget it, remind me to give you like a tutorial on how to use the features within Brightspace, because it's gonna be short answers, but you will be able to use if you can type up a spreadsheet and then copy and paste that spreadsheet, so long as that spreadsheet is a spreadsheet you created on your own, not one of my spreadsheets, but one of your own spreadsheets, and copy and paste the details of that spreadsheet into the exam. It'll work. I'll show you how to do that next session, when we're going over the practice quiz. As a matter of fact, I may actually just put practice quiz on. What's going to be a practice hat? I'll show you how to do it next week on what do we call that? Sandbox. So I have what's called a sandbox course, and right that course I'm going to show you how to do how to play with the Brightspace features. Anything else you guys want to talk about? Brightspace, the quizzes, anything? Nothing at all? Any tax bills that are pending? Anything else? Nothing? All right, so again, this is, believe it or not, we're about halfway through. Wait, are we halfway? Yeah, we're halfway through, about halfway through. Next week is week 5, right? Right? Yeah. So this is halfway through the semester. So we've covered quite a bit of material. As I mentioned before, it's the accelerated semester. We go by it very quickly. But going forward after the midterm, we are going to get into the meat of the information. It's still going to go by fast. The notes are still out there. Continue doing, good work. You guys are doing all good work. Just the midterm, the final, those are your big assignments. Work on the tax preparation assignment for practice, because again, part of the midterm exam will contain a 40-point question that's, you have to walk through everything with the tax preparation assignment. So that's going to be in there. What else?
That's going to be on the midterm.
Yeah, you're gonna have to do a tax return. Well, not that it's the actual forms will take too long, but you have to walk through the same steps. Filing status, what's gross income, taxable income, tax liability, if they get a refund or tax due. It's pretty straightforward. And the only thing that I would say about that, in terms of the tax credit, it's either going to be the $2,000 child tax credit under the 17, or the $500 credit for. So just make sure you look at the dates of birth if it is a qualifying dependent. That's pretty much it for that problem. Again, no more than 3 hours. You have the full day on next Monday, so we're not going to meet next Monday. We will meet on Wednesday. My goal is to have all the exams, and I should have them graded by next Wednesday. That is my goal, is to have all the exams graded by next Wednesday. I'll release the exam scores on Brightspace. You'll see your score by next Wednesday, and I will also release the quizzes or the score. I mean the questions. Oh, and by the way, did you guys get a chance to look at the question answers? I made sure I released the answers to the quiz. If you're having a problem with that, let me know. But they should be available. So as soon as you go through the quiz, you can go through your questions, see which questions you answered correctly or not. And I'm going to do the same thing with the midterm, but I'm going to do it after the fact. Once everybody submits their midterm, and once the midterms are graded, I'll release the actual answer key. I may actually just email it to you for practice. Any other questions on the midterm? Going forward, anything else? Any assessments?
Is the midterm going live on Sunday or Monday? Sorry
Monday.
if you said that.
It's going to be Monday. Yeah, it's going to be Monday, starting Monday. I think for the midterm, it's going to be just Monday. For the final, I'll have it live 2 days, and Tuesday and Wednesday. So the midterm, I'm just going to have it live for that one day. That way, it just limits the students just taking it that one day.
What time is it due? Is it due at 8:10 or for the Monday?
Oh yeah, as long as it's no later than 8:30. So you would have the latest you can get started would be and you just think of it this way: if we were on campus, the latest you would get started would be 5:30. So just look at it that way. That's the latest you would start. The latest you would have to submit the final exam would be 8:30. So to use the full duration, you would have started at 5:30 and then end at 8:30. Then after 8:30, it just stops. So it'll be available that whole day up until 8:30. But here's the thing. Chances are some of you may not even need the full 3 hours. But the full 3 hours, that's there because that's the duration of the class. But I'm guessing many of you, from what it sounds, again, assuming that you continue studying, you may not need the full 3 hours. But it's all up to you. You still got to practice. The practice comes from your end. And we can go over the materials here, but you have to do practice on the questions, exam, quizzes, and everything from your end. All right. So if you don't have any more questions, again, we're gonna do more of a review next session. We are gonna get started, do more detail from analysis on chapter 7. We're not gonna do 8, so we'll get into chapter 7, do more information on 7. I'll get into the computations on net operating losses, but I'm not gonna test you on that on the midterm. I will test you on, on the final, but on the midterm. So again, we'll go over everything up until chapter 7, and then once after the midterm, we'll resume with chapter 8, 9, and 10, and so forth. Just look at it that way. Any other questions? Anything you guys want to ask me? No? If nobody has any questions, I need a motion to adjourn and a second.
Motion to adjourn.
All right. Thank you, guys. I'll see you guys on Wednesday. Make sure you work on the practice quiz. That's the first thing we're gonna do on next week, or next session, I mean. All right. I'm gonna send you the recorded version once it's available to me. So either tomorrow, I'll send it to you. All right.
Thank you.
All right, thanks. See you guys.
Goodbye.
Yeah.